Welcome back to the Deep Dive, where we unpack complex topics and turn them into actionable insights.
Glad to be diving in again.
Today, we're tackling a subject that might make some of you reach for a strong cup of coffee partnership tax forms, specifically Form 1House65.
Yes, Form 1065. Sounds daunting, maybe.
It can. But before you tune out, hear me out. We're not just reading a manual here. Our mission today, based on the sources you sent over, is to really navigate Form 1065, the U.S. return of partnership income.
Right.
We want to clarify not just what to report line by line, but maybe more importantly, how you can potentially optimize your tax situation, find those savings.
Exactly. Think of it as a strategic roadmap.
So let's get into it. Let's unpack this financial puzzle.
Yeah, understanding the details of partnership tax isn't just about checking boxes. It's really about empowering yourself with knowledge that can directly impact your bottom line.
Absolutely.
We'll try to clarify the what and the why so you grasp not just the rules, but like what they actually mean for you and your business.
Okay, let's start at the very beginning then. What exactly is Form 1065 and why is it such a cornerstone for partnerships?
Okay, so at its heart, Form 1065 is the U.S. return of partnership income. Now, here's a fundamental concept that's, well, often misunderstood.
Okay.
While partnerships file this form, the partnership entity itself is generally not subject to income tax.
Right, it's a pass-through entity.
Precisely. The income, deductions, credits, all those tax items, they pass through directly to the partners.
So the partners pay the tax on their share.
Exactly. The partners are individually liable for tax on their respective shares of the partnership's income. So Form 1065, it's really an informational return.
Gotcha. A crucial one, though.
Oh, absolutely vital. It's the conduit for transmitting all that critical tax data to each partner so they can prep their own personal tax returns accurately. It reports what the partnership did, but the tax bill. That lands squarely on the owners.
That distinction is, absolutely critical.
Yeah.
So when the IRS talks about a partnership for tax purposes, how broad are we talking? Is it just formal agreements or is it wider than that?
That's a really good question, because the IRS definition is quite broad. It definitely extends beyond just formal signed agreements.
Okay.
A partnership for tax purposes is generally defined as like a relationship between two or more persons who join together to carry on a trade or business.
Right. Working together.
Yeah, and the idea is that each person contributes something, could be money, property, labor, skill, whatever, and they expect to share in the profits and losses.
Makes sense.
And this definition applies whether or not there's even a formal written partnership agreement. It covers a whole range of unincorporated organizations, things like limited partnerships, syndicates, groups, pools, joint ventures, basically anything operating with a business or financial goal.
So given that wide scope, are there common situations people might think are partnerships but actually aren't, tax-wise?
Yes, definitely. There are a couple of important ones to clarify. For instance, a joint undertaking where people are just sharing expenses, that's typically not a partnership.
Like splitting gas money for a commute.
Exactly. That's just sharing costs, not a business venture. Also, simply co-owning property that you just maintain and rent out doesn't by itself create a partnership.
Okay, but what if you do more than just rent it?
That's the key nuance. If the co-owners start providing significant services to the tenants, like regular cleaning, maybe property management, concierge services, things like that, then a partnership generally does exist.
So it's the act of service that makes the difference.
Right. It transforms simple co-ownership into a tax partnership.
Okay, that makes perfect sense. So who exactly needs to file Form 1065? Is it just domestic partnerships here in the U.S.?
Generally, yes. Any domestic partnership must file Form 1065. But the requirement actually extends beyond our borders, too.
Oh, interesting. Foreign partnerships, too.
Certain foreign partnerships, yes. They have to file if they have gross income that's effectively connected with a U.S. trade or business, or if they have U.S. source income.
And they report everything.
Yes, when they file, they have to report all their items, foreign and U.S. It's pretty comprehensive.
Wow.
And even a foreign partnership that's only filing to make a specific election, say, to amortize organization costs, they still need to file a Form 1065.
Even just for an election.
Yeah, though in that case it's simpler. They usually just need basic ID info and a statement about the election, so the burden is less, but they still file.
Any other special cases?
There's one more, yeah. For certain financial entities and qualified derivatives dealers, or QDDs, if a partnership is a QDD or has a branch that is, it generally must file Form 10M65, even if it wouldn't otherwise need to. And they have to attach a special QDD statement.
Okay, so it really covers a wide range. Now, let's get practical. I know there's a tip that could save some couples a lot of paperwork and maybe some money. We're talking about spouses running a business together.
Ah, yes. This is an excellent point and a really powerful simplification strategy. It's the Qualified Joint Venture Election, or QJV.
Qualified joint venture.
Mhm.
Okay, how does that work?
Well, if you and your spouse jointly own and operate an unincorporated business, and you both materially participate, and you're the only members,
Just the two of you.
right, just the spouses, and you file a joint tax return together, if all that applies, you can elect to be treated as a qualified joint venture instead of a partnership.
And what's the big benefit of doing that? Sounds like less hassle.
Oh, huge benefit. The main thing is, by making the QJV election, you are not required to file Form 1065 at all.
Wow, avoid the whole form.
Exactly. Imagine skipping that complexity, the compliance burden, the potential cost. Gone. Instead, each spouse just reports their share of the income, deductions, credits, whatever, directly on your joint Form 1040.
How do they do that? Just split it down the middle.
Usually on separate schedules, so typically a separate Schedule C for each spouse showing their share of business income, or Schedule F for farming. And then each spouse files their own Schedule SE for self-employment tax based on their share.
That sounds much simpler.
It really streamlines things. Think about a small craft business, maybe a consulting practice run by a couple. This election could literally save them hundreds, maybe even thousands in tax prep fees and just, time and headaches.
That's a fantastic tip. What are the exact requirements to qualify? Can any married couple do this?
Not quite any. There are specific rules. The business has to be jointly owned by both spouses. It can't be held in the name of a state law entity like an LLC or a formal partnership that's elected partnership status.
Okay, so no LLCs choosing partnership tax treatment.
Right. And critically, both spouses must materially participate in the business. Just sharing expenses isn't enough. Both need to be actively involved in the operations.
So active involvement is key.
Absolutely. If you meet those conditions, you just divide everything up according to your interests and report it on your 1040. It's a really powerful option for simplifying tax life.
Good to know. And just as partnerships start, they also end. What happens for tax purposes when a partnership just stops operating?
Right. When a partnership terminates, it basically means all its operations have ceased. No part of the business or venture is continued by any partners in a partnership form.
So it's really done.
Yeah, completely wound down. The partnership's tax year ends on that termination date. It essentially stops existing for tax purposes then.
And that means a final Form 1065.
Exactly. That triggers the filing of a final Form 1065 for that short tax year ending on the termination date. Now, there are more complex rules for things like mergers or divisions where the business continues in a different form. But for a simple shutdown, the key is that finality of operations.
Okay, so we know what it is and who needs to file. Now let's shift gears to the practical side, the logistics. When and where do you actually send this form in? Because deadlines matter.
They absolutely matter. Missing them can get expensive fast. So generally, a domestic partnership has to file Form 1065 by the 15th day of the third month after its tax year ends.
So for most folks on a calendar year, that's March 15th.
Exactly. For the vast majority, the deadline is March 15th. But there's a little flexibility. If March 15th falls on a Saturday, Sunday, or a legal holiday,
The weekend rule.
right, the due date automatically shifts to the very next business day. So for example, looking ahead to the 2024 tax year filed in 2025, March 15th, 2025 is a Saturday.
So the deadline would be?
Monday, March 17th, 2025. You get that little bit of extra time. But yeah, definitely mark that calendar. Penalties for being late can add up quickly.
Good reminder. And where does it go? Is there just one IRS address for all these?
It's not quite one single address, but it's fairly centralized for most. Most domestic partnerships will file with the IRS Service Center in Ogden, Utah.
Ogden, okay.
Yeah. There's a specific separate P.O. Box address there just for foreign partnerships. And the exact address might also depend on a couple of other things, like if you're filing certain complex schedules, like Schedule M3, or if your total assets are above a certain amount.
So best bet is to check the latest instructions.
Always. Definitely consult the current year's Form 1065 instructions for the precise mailing address. You want to make sure it gets to the right place without any delays.
Makes sense. Now, electronic filing. It seems like everything's going digital.
Oh.
What are the rules for partnerships? Have they changed recently?
Big changes here, actually. This is a significant development, especially starting with tax years beginning on or after January 4 in 2024.
Okay, what's new?
Electronic filing for Form 1065 and all its related forms and schedules is now mandatory for partnerships that file, get this, 10 or more returns of any type during the year.
10 returns of any type, not just the 1065.
Exactly. That threshold is broader than many realize. It includes income tax returns, sure, but also information returns like 1099s, employment tax returns like W-2s, even excise tax returns.
Wow, so a partnership with a few contractors and employees could easily hit that.
Very easily. A handful of 1099s, a few W-2s, maybe an excise form, and boom, you're over the 10 return threshold and must e-file your Form 1065.
And what about larger partnerships?
Partnerships with more than 100 partners. They are always required to file electronically, regardless of that 10 return count.
So the trend is definitely pushing towards digital.
Absolutely. It's a clear push from the IRS towards electronic processing for efficiency and accuracy.
That's a pretty wide net. Is there any way out? Like if e-filing would be a genuine hardship for a small partnership?
Yes, there is a waiver process, but it's not automatic or easy to get. The IRS may grant a waiver if a partnership can really demonstrate that e-filing would cause a significant hardship.
How do you ask for that?
You need to submit a specific written request to the Ogden Submission Processing Center detailing the reasons for the hardship. It's generally reserved for, legitimate, unavoidable situations. It's not a common exemption. The IRS definitely prefers e-filing.
Okay. Beyond just sending it in, there are important details about like signing it correctly and making sure the IRS can actually process it. What should partnerships keep in mind there?
Absolutely crucial points. First, the return must be signed by a general partner or an LLC member manager. That signature is certifying the return's accuracy.
Makes sense.
And here's a very practical feature. The Paid Preparer Authorization checkbox.
I've seen that. What does checking yes actually do?
It's a real time saver, potentially.
Yeah.
If you check yes in the signature area, you're basically giving the IRS permission to contact your paid preparer directly for specific limited things.
Like what kind of things?
If there's missing information or questions about how the return was processed or maybe responding to certain notices about math errors, the IRS can just call your preparer instead of you.
So it smooths out communication, but it's limited, right? It doesn't give the preparer free rein.
Exactly right. It's important to remember, checking yes does not authorize the preparer to, say, agree to anything binding on behalf of the partnership or represent the partnership in a broader sense before the IRS.
For that, you'd need.
For broader representation, you typically need to file a Form 2848 Power of Attorney. This authorization is just for those specific processing questions. It's a useful distinction.
Good to know. And what about the backbone of the record keeping and accounting methods? How critical is that?
Paramount. Absolutely paramount. The accounting method the partnership uses, usually cash or accrual, needs to be applied consistently. It has to be reconcilable with the partnership's actual books and records.
And clearly show income.
Yes. Most importantly, it must clearly reflect income. For example, if you're on the accrual basis, income is generally recognized when all the events have happened that fix your right to receive it, and you can determine the amount accurately. That's usually when it's earned, or due, or maybe when title passes.
And expenses, too.
Similar idea for expenses. All events fixing the liability have occurred, the amount is known, and something called economic performance has happened. These rules keep things consistent and prevent, playing games with timing income or expenses.
So good records are non-negotiable.
Absolutely. Meticulous records supporting every number on that Form 1065 aren't just good practice, they're legally required, essential for accuracy and surviving any potential audit scrutiny.
And what if you mess up? You file, then realize something's wrong. Is amending the return straightforward?
It's definitely possible to file an amended return. The process kind of depends on how you filed the original electronically or on paper. The same e-filing rules generally apply to amended returns too.
So if you had to e-file the original, you probably have to e-file the amended.
Generally, yes. For an e-filed amended return, you'll complete a new Form 1065, check a specific box, it's box G5 on page 1 to show it's amended, and you must attach a statement.
What goes in the statement?
It needs to detail each item that's changed, show the corrected amount, and briefly explain why you're making the change.
And what about the partner's K-1s?
Crucial point. If any information previously sent to partners on their Schedule K1 or Schedule K3 was incorrect, you must also file amended K1s or K3s with the amended 1065. And you have to give those corrected forms to the partners too, making sure the amended K1 or amended K3 box is checked.
Makes sense, so everyone has the right info.
Exactly. It ensures the partners can amend their own returns if needed.
Okay, last question on logistics. Are there any common, really simple mistakes people make when putting the return together that can lead to penalties? Easy things to avoid.
Yes, there's one that's surprisingly common and easily avoidable. When you're filling out the Form 1065, make sure all the applicable entry spaces are actually completed.
Don't leave blanks.
Right. Or worse, don't just write C attached in a box where a number or a specific entry belongs.
I could see people doing that.
Yeah, but the IRS can treat that as an incomplete return, and penalties might apply because they can't process it correctly. If you genuinely need more space for details or an explanation, fine, attach separate sheets.
So put the totals on the form itself.
Exactly. Always put the partnership's name and EIN on every attached sheet and make sure the totals or required entries are actually on the printed form where they belong. Just being meticulous avoids a lot of hassle.
All right, we've nailed the filing mechanics. Now let's pivot to some of the maybe bigger picture stuff, the operational choices and strategic elections partnerships can make. These can really impact the partnership's tax life, right?
Yeah.
And therefore, the partner's individual taxes.
Absolutely. These choices can be foundational. One of the most fundamental decisions for any new business, or even an existing one with multiple members, is its tax classification.
How it's treated for tax purposes.
Exactly. Using Form 8832, an entity with at least 2 members can actually choose. It can choose to be taxed as a partnership, or it can elect to be taxed as an association, which usually means being taxed like a corporation.
What if they don't choose? What's the default?
Good question. If a domestic eligible entity like an LLC with 2 or more members doesn't file Form 8832, it automatically defaults to being classified as a partnership for tax purposes.
Okay.
So if you want something different or you just want to formally lock in the partnership classification, you use Form 8832, and you have to attach a copy to the Form 10065 for the year you make that election.
And that choice matters a lot, right? Corporation versus partnership.
Oh, hugely. It dictates whether income flows through to the partners or if the entity itself pays tax. It affects tax rates, how distributions are treated, the overall complexity. It's a really big decision.
So the partnership entity itself makes a lot of the big tax decisions that affect everyone involved.
That's generally right. The partnership makes most of the core operational tax decisions that impact all the partners' shares. Things like choosing the overall accounting method, cash or accrual, deciding on depreciation methods for assets.
What are some other key elections made at the partnership level?
Well, a really significant one is the Section 179 election.
Ah, the expensing election.
Exactly. This lets the partnership choose to immediately expense the cost of certain qualifying property put into service during the year instead of depreciating it slowly over time.
Which gives a bigger deduction upfront.
Right. It can provide a significant immediate deduction that reduces the taxable income flowing through to all the partners that year. Very popular election.
What else?
Other elections might be specific to certain industries, like rules for mines or wells, or maybe related to foreign income reporting. And importantly, the partnership also makes the decision about the centralized partnership audit regime. That's a big one.
Okay, let's talk about that audit regime. You mentioned it's a big deal, and there's a way for some partnerships to opt out. That sounds like a potential major simplification.
It is. This is a really valuable strategy for eligible partnerships. A partnership can elect out of the centralized partnership audit regime for a tax year if it meets certain criteria.
What's this centralized regime quickly?
It was established by the Bipartisan Budget Act of 2015. People often call it the BBA rules. It changed how partnership audits work.
Okay, so how do you opt out? Who's eligible?
The main requirement is being an eligible partnership. Generally, that means having 100 or fewer partners during the year.
100 partners or less.
Right. And crucially, none of those partners can be certain types of entities that would block the election. Things like other partnerships, most trusts, or certain corporations that issue their own K-1s. The idea is to limit this opt-out to simpler structures.
So if a smaller partnership qualifies and chooses to opt out, what's the benefit if they get audited? Fewer headaches.
Potentially, yes, big time. If an eligible partnership opts out, it avoids those more complex BBA audit rules. Under the BBA rules, audit adjustments are usually made at the partnership level, and the partnership itself might have to pay the tax deficiency.
The partnership pays, not the partners.
It can, or it has to deal with complex push-out rules to allocate the adjustments back to the partners from the year being audited. It gets complicated.
So opting out avoids that.
Yes. If you elect out, any audit adjustments are handled at the individual partner level for the year under review. Each partner is then responsible for reporting and paying their share of any extra tax, interest, and penalties directly on their own return.
That sounds much simpler for the partnership itself.
It can significantly simplify things for the partnership, potentially lowering the administrative burden and compliance costs of an audit. For a small or medium-sized business, this election can be a real lifesaver, letting them avoid navigating that potentially complex entity-level audit process. It's a really powerful tool for proactive tax management.
That is a fantastic insight. So while the partnership makes these big choices, you mentioned individual partners also have their own elections they can make on their personal returns.
That's right, and this is where individual tax optimization really comes into play. These are some powerful tax-saving or deferral strategies available just at the partner level.
Like what? Give us an example.
Okay, a good one is under Section 59E. This allows a partner to choose how they deduct certain qualified expenditures. Things like intangible drilling costs, maybe from oil and gas activities, or research and experimental R&E costs.
What's the choice?
Instead of deducting them all immediately in the year they're incurred, the partner can elect to deduct them ratably, meaning spread them out evenly over a 10-year period.
Why would someone want to spread out a deduction?
It can be really useful for managing income fluctuations. Maybe you had a lower income year when the expense occurred, but expect higher income in the future. Spreading the deduction over 10 years could give you a better tax benefit over time. Or maybe you just want to smooth out your taxable income.
So it gives partners flexibility based on their own situation.
Exactly. It lets them tailor things. If they have a super high income year, maybe they take the immediate deduction. If not, maybe spreading it out is better.
Are there other significant partner-level elections like that?
Yes, there are. Section 108, for instance, deals with income from discharge of indebtedness like canceled debt. Under certain circumstances, like insolvency or bankruptcy, a partner might elect to exclude that income and instead reduce other tax attributes.
Okay.
Another one is Section 617, which involves deducting and recapturing mining exploration costs. Again, these are choices made on the individual partner's tax return, not by the partnership.
So each partner can really customize things.
It gives them that flexibility based on their unique financial picture, other income sources, overall tax strategy. It's a real advantage.
Okay, finally in this segment, let's talk about contributing property. What happens when a partner puts, say, a building or land into the partnership? Or when the partnership sells that property later? This sounds like it could get complicated with basis.
It can indeed. It involves understanding basis adjustments. When a partner contributes property, the partnership generally takes the partner's adjusted basis in that property at the time of contribution. That's the starting point for the partnership's basis.
Plus any gain the partner recognized, right?
Right, plus any gain the partner recognized on the contribution itself, though often contributions are tax-free. The real complexity kicks in when there's a difference between the property's tax basis and its fair market value at the time it was contributed.
That isn't his call.
That's known as built-in gain or built-in loss.
Okay, built-in gain or loss. What happens with that when the property is eventually sold by the partnership?
This is where special allocation rules under Section 704C come into play. When the partnership later sells or disposes of that contributed property, it has to allocate the income, gain, loss, and deductions from that property among the partners carefully.
How so?
Essentially, the goal is to make sure the contributing partner bears the tax consequences of that built-in gain or loss that existed before the contribution.
Can you give an example? Say I contribute land I bought for $50K, but it's worth $100 when I put it in the partnership. Then the partnership sells it for $120K.
Okay, perfect example. You have a $50,000 built-in gain, $100 fair market value minus your $50 basis when you contribute it. The partnership sells it for $120K, so the total gain is $70,000. $120K sale price minus the $50 carryover basis. Right.
Under
Section 704C, that first $50,000 of gain, the built-in gain has to be allocated specifically to you, the contributing partner.
Because that appreciation happened on my watch.
Exactly. The remaining $20,000 of gain, $120K sale price minus the $100K value at contribution. That's the post-contribution appreciation. That part gets allocated among all the partners, including you, based on your normal profit-sharing agreement.
That seems fair. Prevents shifting gains around.
Precisely. It ensures the tax burden matches the economics.
What about the flip side? What if the property had a built-in loss? Say I put in property with a basis of $100K, but it was only worth $70K.
This is where there's a key difference, kind of an anti-abuse rule.
Oh.
If there's a built-in loss basis is higher than fair market value at contribution, that built-in loss can only be allocated to the contributing partner when it's recognized.
Only the person who brought the loss in gets to use it.
Correct. For all the other non-contributing partners, the partnership's basis in that property is treated as being equal to its fair market value at the time of contribution, but only for the purpose of calculating their share of any subsequent loss.
So they can't benefit from my pre-existing loss.
Exactly. It prevents partners from contributing lost property just to pass those tax deductions on to other partners who didn't economically suffer the loss. It keeps the tax benefits aligned with who actually bore the economic loss prior to contribution.
All right, let's get into the real nuts and bolts now. The heart of partnership tax. How income and expenses get categorized and reported on Form 1065. It's definitely not just one big number, right?
Absolutely not. The IRS is very particular about separating different types of income and deductions. On page 1 of Form 1065, that's where you primarily report the partnership's trade or business activity income and deductions.
So the main operating stuff.
Exactly. Income or loss from the core business operations, the buying, selling, providing services, whatever the partnership actually does.
Okay, but what doesn't go on page 1?
This is crucial. Things like rental activity income or loss and portfolio income, think interest, dividends, royalties. Those are not reported on page 1.
Where do they go?
They're considered separately stated items. They bypass page 1 and flow directly onto Schedule K, which is the summary for all partners, and then onto each partner's individual Schedule K1.
Why the separation?
Because these items often have different tax implications or limitations for the individual partners. Rental income might be subject to passive activity rules. Portfolio income might affect investment interest expense limitations. Separating them is essential so partners can apply their own specific tax situations correctly.
Got it. Okay, let's walk through some specific deductions partnerships can take. Any common areas for mistakes or maybe missed opportunities here?
Yeah, let's hit some key ones. First, salaries and wages paid to employees. Generally deductible. Big thing here is making sure you don't double count them if they're already included in, say, cost of goods sold. And also, don't include elective contributions to employee retirement plans like 401ks here. Those are usually reported elsewhere.
Okay. What about payments to partners?
Guaranteed payments to partners. This trips people up sometimes. These are payments to a partner for services or for the use of capital, but the key is they are determined without regard to partnership income.
Like a fixed salary for a partner?
Exactly. Think of it like a salary or a fixed interest payment on capital, regardless of whether the partnership made a profit that year. These are deductible by the partnership reported on line 10.
Does this include health insurance for partners?
Yes. Importantly, amounts the partnership pays for health insurance for partners, their spouses, and dependents are generally treated as guaranteed payments too.
And how is this treated for the partner? Is it passive income?
Generally, no. Guaranteed payments for personal services are usually not considered passive activity income for the partner receiving them. That can be important.
Okay. What about repairs and maintenance?
Deductible, but only if they relate to a trade or business activity. And here's an interesting choice. The partnership can elect to capitalize certain repair and maintenance costs if it's consistent with how they treat them on their books, and it follows IRS capitalization rules.
So deduct now or capitalize and depreciate?
Right. It gives you a strategic choice. Deduct immediately to lower current income, or capitalize and spread the deduction over the asset's life via depreciation. Think replacing a minor part versus a major roof replacement. One's likely a repair, the other a capital improvement.
Okay. Now, business interest expense. I know there have been limitations here recently.
Yes, the BIE limitation under Section 163J. Since 2017, the deduction for business interest expense is generally limited for many businesses, especially larger ones or those with a lot of debt. It can really restrict how much interest you can deduct each year.
But you mentioned an exception. This sounds like a potential tax saver.
It is. This is a fantastic nugget for many listeners. Avoiding the business interest expense limitation.
Tell us more. How do you avoid it?
This is a major relief. A small business taxpayer is not subject to this BIE limitation. And if you're not subject to it, you don't have to file the complex Form 8990 used to calculate the limit.
Okay, who qualifies as a small business taxpayer?
Two main things. First, you can't be a tax shelter. Second, you have to meet the gross receipts test.
Gross receipts test, what's the number?
It means having average annual gross receipts of $30 million or less for the 3 prior tax years. So for 2024, you'd look at the average gross receipts for 2021, 2022, and 2023.
$30 million average. That covers a lot of partnerships.
It does. And importantly, when you calculate that average, you have to aggregate gross receipts from all businesses, treated as a single employer under related party rules. You can't just split things up to sneak under the limit.
Right. But if you meet it,
If you meet that test, you can generally deduct all your business interest expense. No limitation. It's a direct, often substantial tax benefit, meaning lower taxable income flows through to the partners. Imagine a partnership with $25 million in average receipts and $1 million in interest expense. They deduct the whole million. A slightly larger one might be limited and have to carry forward a big chunk of that interest. It's a huge difference.
that's a really significant exception. Okay, what about other common costs like employee benefits or maybe going green?
Sure. Employee benefit programs.
Yeah.
Contributions the partnership makes for employee benefits like health insurance, welfare programs, things like that are generally deductible, provided they weren't claimed elsewhere. Just remember, as we said, partner health insurance is usually a guaranteed payment, not an employee benefit expense here.
Got it. And energy efficiency.
Yes, the energy efficient commercial building deduction. Partnerships can claim this valuable deduction if they install certain energy-efficient property. You need to complete and attach Form 7205.
So another clear tax-saving opportunity.
Definitely. It encourages investment in things like efficient HVAC, lighting, building envelope improvements. It can directly reduce the partnership's taxable income.
Okay, what about travel, meals, and entertainment? Always a tricky area.
Yeah, the rules here are specific and have changed. Business travel expenses. Generally deductible. Non-entertainment related business meals. Also deductible, but usually subject to a 50% limitation.
Only half the cost.
Typically, yes. Only 50% of the otherwise allowable cost for business meals is deductible, and entertainment expenses, generally not deductible at all anymore. Things like sporting event tickets, golf outings, etc., even if for business, are usually non-deductible. Same for most club dues related to entertainment.
Ouch. What about taking someone with you on a business trip?
Special rules there, too. For the cost of an accompanying individual, like a spouse, to be deductible, they generally must be an employee of the partnership, their travel must be for a bona fide business purpose, and the expenses must be otherwise deductible. So just bringing someone along for fun, not deductible.
Okay, strict rules there. Now let's navigate this complex world of activity classifications.
Yeah.
You mentioned passive activities. This seems like it can dramatically affect whether partners can actually use losses from the partnership.
You've hit on an absolutely critical area. The passive activity rules under Section 469 are central. They determine how losses flow through and if they can be deducted now.
So what makes an activity passive?
Generally, a trade or business activity conducted through a partnership is considered passive if the partner does not materially participate in that activity.
Material participation.
Yeah.
That's the key. And who decides that?
Yes, material participation is key. And critically, each individual partner determines their own material participation level for each activity. It's not a partnership-level determination.
Why is that distinction so vital?
Because losses from passive activities are generally limited. You can usually only deduct passive losses against passive income. You cannot use passive losses to offset non-passive income like wages, salaries, or portfolio income like interest and dividends.
So passive losses get trapped if you don't have passive income.
Exactly. They get suspended and carried forward until you have passive income or dispose of the entire activity. That's why the partnership, while reporting its overall income or loss, must also separately report the income and deductions from each distinct trade or business activity on attached statements.
To help partners figure out their participation.
Precisely. It gives partners the detailed information they need to determine if they materially participated in that specific activity and then apply the passive loss rules correctly on their own returns.
Okay, so material participation is crucial for trade or business activities. What about rental activities? Are they automatically passive?
That's the general rule, yes. By default, most rental activities are considered passive regardless of whether the partner materially participates.
Always passive. Are there exceptions?
Oh, yes. There are several important exceptions where a rental activity is not treated as a rental activity for passive loss purposes. This usually happens when there's significant turnover or services involved.
Like what kind of situations?
Okay, it's not a rental activity if, for example, 1, the average period of customer use is 7 days or less. Think short-term rentals like cars or maybe very transient lodging. 2, or the average use is 30 days or less and the partnership provides significant personal services. Think of a typical hotel providing daily cleaning, etc. 3, or if extraordinary personal services are provided where the property use is really incidental to the services, like in a hospital. 4, also, if the rental is just incidental to a non-rental business activity. 5, or if the property is normally available for non-exclusive use by customers, like a golf course. 6, or if you provide property for use in another partnership you own.
And guaranteed payments.
Right, guaranteed payments from a partnership are never rental income. So if your rental falls into one of these exceptions, its income or loss might be treated as non-passive, which could be good if it's generating losses you want to deduct against other income.
Okay. Now, you mentioned rental real estate specifically. There's a
Yeah.
special allowance there, right? This sounds like another key tax-saving tip for real estate investors.
Yes, this is a very valuable one. While rentals are generally passive, there's a special rule for partners who actively participate in a rental real estate activity.
Active participation. Is that different from material participation?
Yes, it's a lower standard. Active participation doesn't require the same regular, continuous, and substantial involvement. It generally means making significant management decisions or arranging for others to provide services, things like approving tenants, setting rental terms, approving capital expenditures or repairs.
Even if you have a property manager for day-to-day stuff.
Potentially, yes. If you're involved in those key decisions, you might meet the active participation standard.
And if you do, what's the benefit?
If you actively participate, you may be able to deduct up to $25,000 of rental real estate losses against your non-passive income.
$25,000 in losses against, say, wage income.
Exactly. This $25,000 allowance is phased out, though, for higher income taxpayers. The limit starts reducing once your modified adjusted gross income goes over $100,000 and disappears completely above $150,000. But for those below the phase-out, it's a great way to unlock deductions from rental properties that would otherwise be suspended passive losses.
That's a big deal for many real estate investors. What about grouping activities? Can a partnership combine different operations to, say, meet the material participation test?
Yes, grouping activities is another strategic consideration under the passive activity rules. A partner can choose to treat one or more trade or business activities or even rental activities as a single activity if they form an appropriate economic unit.
How do you determine if they're an appropriate economic unit?
It depends on all the facts and circumstances. The IRS looks at factors like, are the activities similar? Do they share common management or control? Are they interdependent? Do they operate in coordination? Things like that.
Why would you group them?
Well, if you group activities, you test your material participation based on the combined activity. So maybe you don't spend enough time on any single activity to meet the test, but your time across the grouped activity does meet it. That could turn passive losses from the whole group into non-passive, deductible losses.
Interesting. Are there restrictions?
Yes, there are rules. You generally can't group rental activities with trade or business activities unless one is really insignificant compared to the other, or if the owners have the exact same ownership percentages in all the activities being grouped. It needs careful thought and must be applied consistently year after year.
Okay. And what about this recharacterization of passive income? That sounds like something that could flip the script on a partner.
It certainly can. It's basically a set of rules designed to prevent taxpayers from artificially creating passive income just to absorb passive losses. Under certain circumstances, income that looks passive might be recharacterized by the IRS as non-passive.
When might that happen?
Yeah. One common situation is with significant participation passive activities, or SCPAs. That's where a partner participates for more than 100 hours in an activity, but not enough to meet the full material participation test, which usually requires over 500 hours or meeting other tests. Net income from SPAs might be recharacterized as non-passive.
So you put in significant time, but not quite enough, and the income might become non-passive anyway.
Potentially, yes. Other rules can recharacterize income from renting non-depreciable property or from certain equity-financed lending activities. The partnership's role is to identify activities on the K-1 that might be subject to these rules, and then the partner makes the final determination based on their specific facts.
Good to be aware of. Now, what about loans between a partner and the partnership? Interest payments going back and forth, that seems like it could get complicated, especially with the passive activity rules. Is there a simplification strategy here?
Yes, it definitely can get complicated, and this brings us to another important tax-saving, or really simplification point: the self-charged interest rules.
Self-charged interest, what's that about?
Okay, think about this scenario. A partner lends money to their partnership. The partnership pays interest back to the partner.
Right.
For the partner, that interest income is normally portfolio income, which is non-passive. But the partnership's interest expense on that loan might be a passive deduction for that partner if the partnership's main activity is passive to them.
So the partner has non-passive income and passive expense from the same loan. They wouldn't net out.
Exactly. Without a special rule, the partner couldn't offset the passive expense against the non-passive income. That doesn't seem fair, right? It's essentially interest paid to oneself.
Yeah, seems odd. So the rules fix this.
Yes, the self-charge interest rules generally recharacterize a portion of the partner's interest income from the loan as passive income, but only up to the amount of their share of the passive interest expense from that same loan. This allows the income and expense to offset each other, reflecting the economic reality.
Okay, that makes sense. But you mentioned simplification.
Right. While those rules achieve fairness, they can be complex to apply. So the partnership can actually make an election under the regulation, specifically Regs Section 1.469-7G, to opt out of applying these self-charged interest rules altogether.
Why opt out of a rule that seems fair?
Simplicity. If the partnership elects out, they don't have to track and apply these potentially complex recharacterization rules. It just simplifies the reporting for both the partnership and the partners. They just treat the interest income as portfolio and the expense according to the activity's character,
How do they make that election?
by attaching a statement to the partnership return. But, big caveat, once made, this election applies to that year and all future years, and it generally can't be revoked without IRS consent. So it requires careful thought about the long-term impact versus the administrative simplification. It's a trade-off.
Okay, valuable simplification option there. Finally, on income types, what exactly is unrecaptured Section 1250 gain? That sounds very specific.
It is quite specific. Partnerships need to separately report this type of gain. It generally arises from the sale of depreciable real property buildings, usually that the partnership used in its business and previously depreciated.
So it relates to depreciation taken on buildings.
Yes. It can also flow through from the sale of an interest in another partnership that holds such property, or even from investments like real estate investment trusts, REITs.
Why is it reported separately? Does it get taxed differently?
Exactly. This specific type of gain, which represents the recapture of some of the prior depreciation deductions taken on the real property, is taxed at different capital gains rates for individual partners. It's usually capped at a 25% rate, which can be higher than the normal long-term capital gains rates, which might be 0%, 15%, or 20%.
Ah, so the partnership has to flag it so partners pay the right, potentially higher rate on that piece of the gain.
Precisely. It ensures that some of the benefit of those past depreciation deductions is recaptured at this special rate when the property is sold.
Okay, we've covered the partnership's overall return, Form 1065 itself. Now let's zoom in on how partners actually get their specific piece of the pie for their own tax returns. The 1065 is the big picture, but the info for each partner comes from somewhere else, right?
Exactly right. That's the critical role of Schedule K, and especially Schedule K1.
Okay, Schedule K and K1. What's the difference?
Think of Schedule K as the master summary. It's part of the Form 1065 filed by the partnership, and it summarizes the total collective shares for all partners of all the income, deductions, credits, etc. Every partnership has to complete Schedule K.
So K is the total for everyone.
Right. Then Schedule K1 is the personalized version. There's a separate K1 prepared for each individual partner, showing their specific share of all those items listed on Schedule K.
And the partner gets this K1.
Yes. A copy of each K1 gets attached to the Form 1065 the partnership files with the IRS. The partnership keeps a copy. And crucially, the partnership must furnish a copy of the K1 to each partner by the partnership's return due date, including extensions.
So that K1 is gold for the partner doing their taxes.
Absolutely. It's the foundational document each partner uses to report their share of the partnership's activity on their own Form 1040 or other return.
Do foreign partnerships always issue K1s?
Generally, if they have U.S. partners and have to file Form 1065, yes. But they might not be required to provide K1s for their foreign partners. Unless maybe a U.S. person holds an interest indirectly through that foreign partner. It depends.
Okay, so let's dig into the K-1 itself. What specific information on there is absolutely vital for a partner?
Well, beyond the basic identifying info for the partnership and the partner name, address, ID numbers. And remember that little detail about IRAs. If an IRA owns the partnership interest, you use the custodian's EIN, not the individual social.
Right, good tip. What about the financial stuff?
Part 3 of the K-1 is where all the action is. It details the partner's distributive share of every single income, deduction, credit item. Let's break down some really key items there. First, Item J, partner's profit, loss, and capital percentages. This shows the partner's percentage share of profits, losses, and capital, usually at the beginning and end of the year, based on the partnership agreement. Super fundamental for understanding how things are allocated.
What if their capital account is negative? Does that affect the percentage?
Good question. For reporting the percentage ownership itself in Item J, if a partner's capital account is negative, you generally express their percentage ownership of capital as 0. The negative balance itself shows up elsewhere.
Okay. What else is critical?
Item K, partner's share of liabilities. This is incredibly important. It breaks down the partner's share of different types of partnership debt. Recourse liabilities, non-recourse liabilities, and qualified non-recourse financing.
Why do the liabilities matter so much to the partner?
Because a partner's share of liabilities generally increases their adjusted basis in their partnership interest. And basis, along with something called the at-risk amount, determines how much loss a partner can actually deduct. More basis usually means potentially more deductible losses.
Ah, so tracking your share of debt is key to unlocking loss deductions.
Exactly. And that qualified non-recourse financing, usually debt secured by real estate used in a real estate activity, is treated as an amount at risk, which is particularly helpful for deducting losses from real estate ventures. Understanding these liability numbers can make a huge difference.
Makes sense. What's next?
Item L, partners capital account analysis. This is another critical piece, especially now that partnerships are generally required to report partner capital accounts on the tax basis method.
Tax basis method. What does this section show?
It's basically a reconciliation showing how the partner's tax basis capital account changed during the year. It starts at the beginning balance, adds capital contributions, adds the partner's share of taxable income, or subtracts their share of loss, accounts for other increases or decreases like tax-exempt income or non-deductible expenses, and subtracts withdrawals and distributions.
So it tracks their investment on a tax basis.
Precisely. It tracks their equity in the partnership from a tax perspective.
Mm-hmm.
And yes, a partner's ending capital account here can be negative if losses and distributions have exceeded their contributions and income.
Why is this Item L analysis so vital?
Because while it's not exactly the same as the partner's overall adjusted basis, which also includes their share of liabilities from Item K, it's a crucial component of it. Partners need this information to properly track their outside basis, which again limits loss deductions and determines if distributions are taxable. The partnership provides the Item L analysis. The partner uses it, plus Item K and other adjustments, to figure their overall basis.
Okay, really important pieces there. Now, I see box 14 on the K-1 is for self-employment earnings. How does this work differently for general partners versus limited partners? This affects taxes, right?
Big time. This directly impacts how much Social Security and Medicare tax a partner owes. For general partners, their distributive share of the partnership's ordinary business income, or loss, is generally included in their net earnings from self-employment, so they usually pay SE tax on that income.
And for limited partners.
For limited partners, the rules are much more restrictive. Generally, only guaranteed payments they receive for services they actually rendered to the partnership are treated as self-employment earnings.
So if a limited partner just invests capital and gets a share of profits, but doesn't work in the business,
typically, that profit share is not subject to self-employment tax for a limited partner, but if they also receive a guaranteed payment for, say, management services they provided, that payment would be subject to SE tax.
what about other income types, like interest or dividends, pass through?
Generally, things like income from group investments, dividends, interest, unless you're a dealer, real estate rentals, unless you provide significant services, and royalties, unless it's your trade or business, are not typically self-employment earnings for other general or limited partners. Understanding this distinction is really key for correctly calculating SE tax.
Definitely. What about box 17, alternative minimum tax, AMT items? Does a partnership figure out the AMT for partners?
No, the partnership itself doesn't calculate the AMT. Its job is to provide the necessary pieces of information. Box 17 reports items of income and deduction that are treated differently for AMT purposes compared to regular tax.
Like what kind of items?
Things like differences in depreciation calculations for certain assets, adjustments to the gain or loss on selling certain property, differences related to depletion for oil and gas, things like that.
So the K1 gives the raw data.
Exactly. The partnership passes through these specific adjustment and preference items, and then each partner takes that information and uses it to calculate their own potential AMT liability on their individual return, usually using Form 6251.
Got it. Now, you mentioned tax-exempt income earlier, like from forgiven PPP loans. That shows up in Box 18, tax-exempt income, right? And it increases basis even though it's not taxed.
That's absolutely correct, and it's a really important point for basis management. Box 18 includes tax-exempt income, like that forgiven PPP loan money. While the income itself isn't taxable, the partnership must report it here and provide a statement.
Why report it if it's not taxed?
Because it increases the partner's basis in their partnership interest. That basis increase is super valuable. It means the partner can potentially receive more distribution from the partnership tax-free in the future, or they might be able to deduct more losses that would otherwise be limited by their basis.
So it's a beneficial item to track.
Very beneficial. Similarly, if the partnership generated tax-exempt income from electing to transfer certain energy credits under Section 62418, that would also be reported here to ensure partners get that basis boost.
Okay, this next one is huge. It affects almost every eligible partner and has been a major tax topic. Let's talk about the Qualified Business Income QBI deduction, Section 199A. This has been a game changer.
It really has. This is arguably one of the most impactful deductions enacted in recent years for eligible taxpayers, individuals, trusts, estates. It allows them to potentially deduct up to 20% of their qualified business income. A massive tax-saving opportunity.
And the deduction is taken by the partner, right? But the partnership provides the info.
Exactly. The deduction itself is calculated and claimed on the partner's individual tax return, but the partnership plays an absolutely crucial role in providing all the necessary building blocks for that calculation. This information primarily comes through in Box 20 using code Z for Section 199A information.
So what specific pieces does the partnership have to give the partners in Box 20, code Z, for them to figure out their QBI deduction?
The partnership needs to break down and report for each separate qualified trade or business it conducts the partner's distributive share of several key items. 1. Qualified items of income, gain, deduction, and loss. This is the core business income or loss, but can also include things like Section 1231 gains losses, Section 179 deductions allocated to the partner, maybe even interest from debt finance distributions if it's tied to the business. 2. W-2 wages, the amount of W-2 wages paid by the partnership that are properly allocable to that qualified trade or business. 3. UBIA of qualified property, that stands for unadjusted basis, immediately after acquisition of qualified property. Basically, the original cost of depreciable tangible property used in the business.
Why are the wages and property bases needed?
Because for partners whose taxable income is above certain thresholds, the QBI deduction can be limited based on either 50% of the W-2 wages or a combination of 25% of the wages plus 2.5% of the UBIA of qualified property. So these numbers become critical limiting factors for higher income partners.
Got it. The partnership also reports.
It also needs to report any qualified PTP publicly traded partnership income or loss and any qualified REIT dividends passed through, as those can also qualify for the QBI deduction, sometimes under slightly different rules.
Now, what about those specified service trades or businesses, the SSTVs? I know they have special, less favorable rules. How does the partnership handle those?
That's a critical piece the partnership must identify. It needs to tell partners whether each trade or business it operates is an SSTB.
Remind us, what counts as an SSTB?
It's businesses providing services in specific fields: health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, and also, importantly, any trade or business where the main asset is the reputation or skill of one or more of its owners or employees. Think celebrity endorsements, for example.
Why is flagging it as an SSTB so important?
Because the QBI deduction for income from an SSTB is generally phased out completely for partners once their taxable income exceeds certain statutory thresholds. For non-SSTB income, the wage UBIA limitations might apply above those thresholds, but the deduction isn't necessarily eliminated entirely. For SSTB income, it often is eliminated for higher income partners. So that SSTB flag on the K-1 is a huge signal.
Wow, okay. Now, is there a way for partnerships that run multiple different businesses to maybe combine them or aggregate them to potentially get a better QBI deduction result? This sounds like it could be a really powerful strategy.
Yes, absolutely. There's an excellent aggregation strategy that partnerships can elect to use for QBI purposes. This can be a highly strategic move.
How does aggregation help?
Well, imagine a partnership has two businesses. Business A has high QBI, but low W-2 wages and low property basis, UBIA. Business B has lower QBI, but lots of wages in UBIA. If treated separately, the QBI deduction from Business A might be severely limited for higher income partners due to the lack of wages UBIA. But if the partnership can aggregate them,
Then the wages and UBIA from Business B can support the QBI from Business A.
exactly. By aggregating, they pool the QBI, W-2 wages, and UBIA from all the aggregated businesses together into one pot for calculating the partner's potential QBI deduction and its limitations. This can often result in a significantly larger overall QBI deduction for the partners compared to treating each business separately.
That sounds amazing. What are the rules for being allowed to aggregate? Can you just combine anything?
No, there are specific requirements that must be met. 1. Ownership. The same person or group must own 50% or more of each business being aggregated for most of the tax year. 2. Tax year. All aggregated businesses must share the same tax year-end. 3. No SSTBs. Critically, none of the businesses being aggregated can be an SSTB. You can't aggregate an SSTB with a non-SSTB. 4. Interconnectedness. The businesses must also show a level of integration. They need to satisfy at least 2 out of 3 specific factors related to operational linkage.
What are those 3 factors?
They are: the businesses provide products, property, or services that are the same or customarily offered together. They share facilities or significant centralized business elements like personnel, accounting, IT, legal, etc. They are operated in coordination with or reliance upon one another. Think supply chain integration, for instance.
So if you meet the ownership, no SSTB, and 2 out of 3 linkage tests, the partnership can choose to aggregate.
Yes, the partnership makes the aggregation election, and it's generally binding on the partners and for future years. It's a powerful planning tool. The partnership also makes the initial determination if an activity even is a trade or business for QBI purposes, and that's binding on partners too.
What kinds of income are generally not QBI?
Generally, QBI does not include things treated as capital gains or losses, most dividends, most interest income, unless it's business interest directly related to the trade, not just investing working capital, any wages the partner might receive, or income that's not effectively connected with a U.S. business.
Okay, that aggregation strategy is definitely something for partnerships with multiple operations to look into. Are there any other really new or notable items popping up on the K-1 that listeners should have on their radar?
Yes, definitely one big one for the 2024 tax year onwards: digital assets reporting. This shows up in Box 20 Code U.
Digital assets, like crypto.
Exactly. Cryptocurrencies, NFTs, non-fungible tokens, stable coins, any similar digital representation of value. The partnership now has to answer yes on the K-1 if, at any time during the year, it received digital assets as payment, reward, etc., or disposed of them, sold them, exchanged them for property or services or another digital asset, or even just held a financial interest in any digital asset.
That sounds incredibly broad.
It is very broad. It means a huge number of partnerships that might have just dabbled in crypto or accepted it as payment will now have to check yes. Here, it clearly signals the IRS's increased focus on tracking these transactions for compliance. Definitely a heads-up item.
Good to know. What happens if the partnership previously claimed a tax credit for some property, but then sells that property early or stops using it the right way? Is there a clawback or recapture?
Yes, absolutely. That falls under recapture of credits, reported in Box 20 using various codes like FGHIM. If property for which a credit was claimed, common ones include the low-income housing credit, investment tax credit, or even the Section 179 deduction is disposed of or its use changes before the end of its required holding or usage period, the recapture period, the partnership needs to provide information to the partners.
What info?
Enough information for the partners to calculate how much of the previously claimed credit or deduction they need to recapture or essentially pay back on their current year tax return. For instance, with Section 179 property, if the business use drops below 50% after you placed it in service, the K-1 needs to show details like the original basis, depreciation taken, and the Section 179 amount originally passed through so the partner can figure out the recapture amount. It ensures the tax benefit aligns with the actual qualifying use.
Makes sense. And one last K-1 related point. For partnerships that do have foreign partners, what specific info do they get, especially regarding U.S. tax rules?
For partnerships with foreign partners, especially if the partnership is engaged in a U.S. trade or business, Schedule K3 becomes very important. Part 13 of Schedule K3 provides information relevant to foreign partners related to Section 864C8.
Section 864C8.
What's that about? It generally treats gain or loss recognized by a foreign partner on the sale or exchange of their partnership interest as effectively connected with a U.S. trade or business, to the extent the partnership itself is engaged in one, so it helps ensure the U.S. taxes that gain.
And this ties into withholding, too.
Yes, it can. There are related withholding rules under Section 1446, where the buyer of a partnership interest from a foreign person generally has to withhold tax. The information on K3 helps with determining the amount subject to these rules and potential withholding obligations on future distributions if prior withholding didn't happen correctly. It's a complex area of international tax, but the K3 provides the necessary data bridge.
Okay, let's step back a bit from the direct flow-through items that hit the K1. Form 1065 also includes these standard financial statements, right? Like the balance sheet and the capital account analyses.
Yeah.
What did these tell us beyond the income and deductions?
They provide a really important financial snapshot and reconciliation for the partnership itself. They give context to the numbers flowing through. Let's look at them. First, Schedule L, the balance sheets per books. This is exactly what it sounds like. A snapshot of the partnership's assets, liabilities, and partner capital at the beginning and end of the tax year based on the partnership's accounting records, its books.
Like a standard balance sheet, assets, liabilities, plus equity.
Exactly. It shows what the partnership owns and owes. A couple of key points here. Total assets should be shown. You can't just net them against liabilities or report a negative asset number. That's a common error. And if the partnership owns an interest in another partnership and uses the tax basis method for that investment, it has to report its adjusted basis in that other partnership interest as an asset on its own Schedule L. And it must also separately show its share of the other partnership's liabilities as a liability on its Schedule L.
Why the separation?
It prevents masking the true asset base. It gives a clearer picture of the partnership's total assets and total liabilities rather than netting things out misleadingly. It's important for transparency, both internally and for external users like lenders.
Okay, that's Schedule L. What about Schedule M1? That's a reconciliation, right?
Yes. Schedule M1 is the reconciliation of income loss per books with income loss per return. This is a super important schedule. It explains why the partnership's net income, or loss, reported on its financial statements, its book income, might be different from the taxable income or loss. It reports to the IRS and passes through to partners on Schedule K and K1s.
What causes those differences?
Lots of things. For example, tax-exempt interest income, like from municipal bonds, would be included in book income but excluded from taxable income. Or maybe the partnership paid penalties that are expensed on the books but are not deductible for tax purposes. Depreciation methods might differ for book versus tax. That PPP loan forgiveness we talked about, included in book income, excluded from tax income, that difference shows up on M1.
So M1 bridges the gap between accounting rules and tax rules.
Precisely. It's a critical tool for understanding those discrepancies, ensuring transparency, and helping reconcile the two different sets of rules. It shows the IRS you've accounted for those differences.
And finally, Schedule M2. This focuses just on the partner's capital accounts.
That's right. Schedule N2 is the analysis of partners' capital accounts. This schedule tracks the changes, specifically on the tax basis, in the partner's collective capital accounts throughout the year.
So it mirrors item L on the K1, but for all partners combined.
Essentially, yes. It starts with the total beginning capital for all partners, adds total capital contributed during the year, adds the total net income or subtracts the net loss for tax purposes from Schedule K, accounts for other increases like that tax-exempt income again or maybe excess depletion, and subtracts total withdrawals and distributions made to partners.
And why is tracking this total capital account movement important?
It provides an overall picture of the equity structure on a tax basis, and it's a vital backup for the individual partner capital account analyses shown on the Schedule K1's item L. It helps ensure the partnership is properly tracking these basis-related items, which, as we've said, are crucial for partners to determine the taxability of their distributions and the deductibility of their losses. It's a key piece of the basis puzzle.
Okay, wow. When you look at all these forms, all these schedules, the detailed instructions, the constant changes, it really does feel like a lot. The IRS even publishes estimates of the taxpayer burden for these forms. What do those numbers tell us about the real cost of compliance for partnerships?
They tell a pretty stark story, honestly. The IRS estimates that the average burden for a partnership filing Form 1065 and all the related schedules and attachments is somewhere around 60 hours of record keeping, learning, preparing, and sending the form.
60 hours. That's like a week and a half of full-time work.
It is, and that's just the average. They also estimate the average out-of-pocket cost at around $5,000. Now, that's not including professional preparer fees, which would be on top of that.
Okay, $5,000 plus potentially significant preparer fees.
Right. And for large partnerships defined as those with over $10 million in assets, the burden estimate jumps dramatically. We're talking about 190 hours on average, and an estimated out-of-pocket cost of around $28,200.
Wow. Over $28,000 plus preparer fees for large partnerships.
Yeah. These are just national averages, of course, and individual situations vary wildly, but they absolutely underscore the significant time, effort, and money involved in partnership tax compliance. It is definitely not a trivial undertaking.
That's really staggering. But it also powerfully highlights why understanding all this information, why doing this deep dive is so valuable. It's not just about compliance. It's about managing that burden and maybe finding ways to optimize.
Precisely. That's the key takeaway. While the compliance burden is undeniably real and significant, arming yourself with knowledge, understanding these instructions, knowing about the elections we discussed, recognizing the reporting requirements is crucial. It allows you to not only ensure compliance, but also to identify those critical opportunities to proactively manage your tax situation.
So knowledge here isn't just power.
It's potentially a direct financial advantage, understanding how income and deductions flow, knowing the impact of elections like the QJV for spouses or the BID small business exception, navigating complexities like passive activity rules or maximizing the QBI deduction. All of that can lead to real tax savings, potentially lower compliance costs, and just better overall financial planning for both the partnership and every single partner. It really is about being informed and strategic. #outro.
Wow. Okay, we have really delved deep into Form 1065 today. We've pulled apart the definitions, navigated the deadlines, walked through those crucial lines and schedules that make up the world of partnership taxation.
A lot of ground to cover.
It really is. We've seen how just one form can reveal so many complex layers, especially around, what counts as a deduction, how tricky areas like passive activities are treated, and maybe most importantly, highlighting those tax-saving opportunities like the QJV election, the BIE exception, or that really impactful QBI deduction.
Yeah, the complexity might seem daunting at first glance.
It definitely can.
Yeah.
But hopefully, armed with these insights from our deep dive today, you listening feel better equipped to understand your partnership's tax obligations, and also maybe better able to spot those areas where you can potentially optimize your tax position.
And that really raises the important question for you, the listener, to consider after this. How might a deeper understanding of your own partnership's specific activities, its financial structure, its partner makeup, allow you to better leverage these rules we discussed today for greater tax efficiency? Maybe unlock some significant savings.
Yeah.
It really isn't just about filling out a form correctly. It's about strategic financial management, using the rule to your advantage.
That is a powerful thought to chew on. How can you leverage these rules? Excellent question. Well, thank you for joining us on this deep dive into the often complex world of partnership tax.
Always a pleasure to explore these details.
Until next time, stay curious and keep exploring.